Hi everyone! Last week was rather volatile on Wall Street. Investors were mainly focused on US inflation data. All components for the index turned out to be worse than expected. Stock markets climbed following its release, although they were declining prior to it. Traders seem hesitant to pick up trajectory, which signals market uncertainty due to persistently high inflation and dim economic prospects. Some speculators still hope that the Fed could slow down the pace of monetary tightening. It fuels optimism on Wall Street from time to time. Even though they desperately want to find solid arguments for a possible shift to a soft stance, there are none. Recently, there have been plenty of economic reports that dispelled their hopes for a dovish stance. Last Friday, inflation expectations rose sharply, triggering market volatility. This week, investors are also going to seek new clues about the Fed's future steps on monetary tightening. They are mulling over whether the Fed will raise the interest rate by 75, 50 or 25 basis points. Apart from that, the earnings season is in full swing. Fresh reports of American companies will reveal how they are coping with current economic problems. Large banks, consumer and industrial companies are going to unveil their third quarter earnings reports this week. Quarterly reports of such tech giants as Tesla, Netflix and Snap are also on tap. Watch our video review till the end and leave your comments down below. Let's start. The inflation report for September revealed that consumer prices slowed for the third month in a row. However, the reading turned out to be higher than anticipated. The energy index went up, but its growth was far more modest compared to August. Food prices dropped slightly while housing prices jumped. Core inflation was up 6.6% from a year ago, the biggest 12-month gain since August 1982. Analysts had expected the figure to be at 6.5%. It means that inflationary pressure remains high and the Fed will stick to its aggressive tightening. The meeting minutes also confirmed the regulator's strong commitment to the hawkish stance. They were published before the inflation report. According to the minutes, many Fed officials are in favor of more rate hikes to tame inflation. The hotter than expected inflation report proved their conjectures. So the central bank will hardly change its stance in the near future. Currently, Fed policymakers are backing a 75 basis point rate hike. Although some investors cast doubt on such a rate increase, they have to admit that such a scenario looks more likely. So at the November and December meetings, the central bank is sure to undertake 2 more rate increases by 75 basis points. Some analysts do not exclude the possibility of a 100 basis point rate increase. However, this scenario is unlikely to come true. Last week there were plenty of macroeconomic reports which somewhat puzzled investors. Wall Street regained optimism for no reason. However, at the end of the week, stocks eventually declined. The University of Michigan survey showed that year-ahead inflation expectations rose for the first time in 7 months. It may force the Fed to act more aggressively, which raises concerns about a possible recession. Tech stocks, which are vulnerable to possible changes in key rates, fell by more than 2.5%. Shares of energy companies decreased by more than 3%. Oil and other commodities were also down. Stock indices extended losses on Friday. The Dow Jones dipped by almost 400 in a highly volatile session, while S&P and NASDAQ sank by 2.1% and 3.1% respectively. The weekly result for the Dow turned out to be positive compared to other stock indices. Despite some drops and Friday's steep decline, its weekly gain was 1.2%. Optimism on Wall Street could have been fueled by the release of fresh earnings reports, as there were no other reasons for a rally. Fundamental factors are still bearish. Traders also studied the revenue reports of the leading US banks. JP Morgan's stock jumped by almost 3% after the publication of an upbeat third-quarter earnings report. Wells Fargo also unveiled a strong report after providing positive revenue estimates. Morgan Stanley and Citigroup shares declined. Both banks reported quarterly revenue below expectations. Apart from earnings reports, the US published retail sales data last Friday. The figure remained unchanged in September, undershooting market expectations of a 0.2% increase. Soaring inflation and rising borrowing costs affected consumer demand. There was a decline in sales in almost all stores. However, sales at grocery stores rose, helped by rising food prices. S&P 500 was trading choppily, whether moving up or down. However, its weekly changes were insignificant. Unlike the Dow, the index ended the week in negative territory. However, all three benchmark indices are likely to recover this week. Stock markets have seen big waves of sell-offs this year. From the January highs, the S&P lost 24%. On Thursday, it briefly fell to new yearly lows but managed to bounce back. The overall trend is still bearish, therefore there have been lots of short-lived rallies. In June, for example, the S&P soared by 17%. Since then, there have been plenty of moderate rises. This is why analysts are trying to figure out whether the index could repeat its summer rebound or at least start a short-term rally. Investors have got rid of most of their shares, causing a sell-off. At the same time, they now have enough money to buy stocks, so a new rally looks likely, although it will hardly be a long-term one due to inflation woes and aggressive rate hikes and the risk of recession. Besides, speculators are rather cautious of sharp trend reversals. They have seen this pattern so many times. A robust rise and then a steep fall to new lows. The question is when the stock market will finally bottom out. It is almost impossible to start a long-term rally against the backdrop of galloping inflation and expectations of sharper rate hikes. The Fed has recently stated that their federal funds rate may reach 5% by the spring of next year, which is bearish for stocks. The S&P dropped to 3,500, 3,520 following the news. After that, the index bounced back 3,640, which acted as a resistance level not long ago. Judging by the technical outlook, this was a bullish reversal. Time will show whether the index could maintain its upward movement. For what it's worth, sooner or later the stock market will hit the bottom. If the index consolidates about 3,640, it may settle at this level for a while. It may return to 3,700, 3,740. If so, it's likely to approach a new high. If it grows above 3,810, it may resume an uptrend. Judging by the trajectory of the heavy-tech NASDAQ 100, it also performed a long-awaited reversal. There was a prolonged flat movement, then a drastic decline amid negative news, and a rebound for no reason. The earnings season may help stock indices regain momentum. However, analysts doubt that it will be a long-term rally. The bearish outlook remains relevant. For the S&P, for example, the target level is located at 3,550 and below. However, investors are tired of constant pessimism. Stocks are extremely oversold as the sell-off has been going on for 2 months. These factors may lead to a bullish reversal. The decline in stock markets was steady, which helped traders close short positions last week. It triggered a downward reversal on Thursday, with indices losing 4% in just a few minutes. Curiously enough, bulls rushed to the market. For this reason, indices offset their losses rather fast. Such a situation rarely occurs in markets. Of course, there were some factors that led to such a scenario. Initially, traders factored in the most pessimistic scenario, namely a 75 basis point rate increase in November and December. In the long term, it would signal a recession. However, fresh economic reports were published reflecting the resilience of the US economy. It appears that the economy continues to add new jobs and real wages are growing. Despite some positive signs, investors should remain cautious. For a long-term trend reversal, markets need strong fundamental drivers. Currently, there are none. A rebound is likely to be a technical one, as there are no positive fundamental factors now. This is why there might be a new sell-off soon. As for the NASDAQ 100, traders should pay attention to its moves near some pivot levels. It has not been able to close a day or week above 11,000. If it consolidates above this level, it may facilitate bullish momentum. The next pivot level is located at 11,200. This is the former support area that was formed in June. Now it may serve as a resistance. If the index reaches this range, then the next target level will be 11,700. If NASDAQ breaks above these levels, it will signal the end of the bearish trend. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you!